Okay, so this is ICAI study material questions given at the chapter end, chapter number 4. Okay, valuation. Briefly explain the following with reference to customs. Determination of value of imported goods rules 2007. Goods of the same class or kind. So goods of the same class or kind means identical goods. So that is the meaning. Okay, so goods of the same class or kind means within the group or range of imported goods produced by a particular industry or industrial sector, and it includes both identical goods and similar goods. That is the meaning of goods of same class. Then computed value. So as per rule 8, we need to take computed value as the cost of production. Cost of production we need to take, then profit and general expenses. So then cost or value associated with rule 10 sub rule 2, that is freight and insurance. After making this, we will get computed value, and that computed value will be taken as the assessable value. Whether the assessable value of warehoused goods which are sold before being cleared for home consumption should be taken as the price at which the original importer has sold the goods. Yes, partly correct. We need to take the assessable value under customs. Assessable value under customs. Okay, so whatever is the assessable value is not the transaction value at which it is sold. For the purpose of computing IGST only, we take the transaction value. But what is the assessable value in case of warehoused goods sold before clearance? So we will take the original assessable value at the time of original import, and for computation of IGST, we will take assessable value plus basic customs duty plus social welfare surcharge, or transaction value at which such goods are sold, whichever is higher. That is only for computing IGST, but not the assessable value under customs. Okay, so therefore section 14 says that we will take the price at which imported goods are sold. Okay, so therefore the sale of goods after warehousing them in India cannot be considered as sale for export to India. It cannot be stated that the export of goods is not completed. Hence, the price at which the imported goods are sold after warehousing does not qualify to be transaction value. So that's why we are taking assessable value as the original import price. But for computing IGST alone, we are adopting a different methodology. Okay, then that is given in. But for IGST, the above is only for basic customs duty and social welfare surcharge. But IGST is leviable as per 3 subsection 8A. For that, we will take the regular computation or transaction value, whichever is higher. Okay. Then question number 3. Explain when are the costs and services as given in rule 10 of customs valuation, determination of value of imported goods rules be added to the value of identical goods under rule 4. So rule 4, so we need to take the value of identical goods, and if the value of identical goods is already a CIF price, we will take that, and we need to make the adjustment with respect to difference in the transportation cost. If the goods are imported in one port, but the identical goods are imported in some other port or airport, so the difference in transportation cost needs to be adjusted. Okay, that is this. So what we need to do, so where cost and charges referred to in rule 10 are included in the value of identical goods, adjustment has to be made for difference in cost and charges between imported goods and the identical goods. That is this. Then question number 4, examine the validity of the following statements with reference to Customs Act, giving brief reasons. Service charges paid to canalizing agent are not includable in the assessable value of import. Such agent import the goods from foreign sellers and enters into agreement to sell such goods with the buyers in India on high seas basis. Now in this case, this canalizing agent is charging some extra amount. Okay, but as this happens on a high seas basis, Hyderabad Industries Limited, a Supreme Court case, they are telling that this canalizing agent is not treated as importer's agent. This canalizing agent is like a reseller. So reseller's commission will be definitely included, because in case of high seas, the last purchase price will be taken. So therefore, what they are telling, this commission or service charges paid to the canalizing agent are includable. So what you need to remember, as per Hyderabad Industries case, Supreme Court case, canalizing agent is not an importer's agent and they are resellers. So commission paid to them will be included in the assessable value, and this cannot be termed as buying commission. Then next one, charges for vendor inspection on the second hand goods carried out by the foreign supplier on his own and not required for making the goods ready for shipment are not includable in the assessable value of the imported goods. So this is given by in Bombay dyeing case, Supreme Court. That is, this vendor inspection charges, so which is on his own account. Actually, for the purpose of good, this was not required. If expenditure is incurred by the exporter on his own account, why it will be included in the value of imported goods? It will not be included. Only the payments actually made as a condition of sale of imported goods by the buyer are includable. But this vendor inspection charges carried out by the supplier on his own will not be includable in the value. Okay. Then next one is number 5. An importer entered into a contract for supply of crude sunflower seed oil at $435 per metric ton CIF price. Under the contract, the consignment was to be shipped in the month of July. The period was extended by mutual agreement and goods were shipped on 5th August at old prices. In the meanwhile, the international prices has gone up due to volatility in the market, and other imports during the month of August were at higher prices. Department sought to increase the assessable value on the basis of higher price of comparable imports. Decide whether the contention of the department is correct with reference to a decided case. So there is one, Agarwal Industries case, Supreme Court, again Supreme Court case. What is that they are telling? So we need to take the contract price, even though there is an increase in price. So already in one question we saw. So whenever there is a contract price and the market price is there, we need to take only the contract price. Okay. So contract price only should be taken in this case. The Supreme Court pointed out that commodity involved has volatile fluctuation. Further, there is no allegation that importer and exporter are in collusion, etc. Therefore, the contract price was accepted as the transaction value. Okay. So this is Agarwal Industries Limited Supreme Court case. Then question number 6, BSA and company has imported a machine from UK. From the following particulars furnished by it, arrive at the assessable value for the purpose of customs duty payable. So we need to take price of the machine 10,000 pounds. Okay. Freight, air freight is given. So usually air freight will be comparable, actual or 20% of FOB, but we need to first arrive at the revised FOB. So FOB price given is 10,000 pounds, but which should be taken as the exchange rate. So for exchange rate, we need to take bill of entry date. What is the bill of entry date? So interbank exchange rate we will not take. CBIC rate we will take 100 rupees per UK pound. So 100 rupees will be taken. So what is the FOB price given? So 10,000 into 100. 10,000 into 100 will be taken. Okay. So that 10,000 into 100. 10,000 into 100. So that, so 10 lakhs will be taken as FOB given. Now to that FOB given, engineering and design charges paid to a firm in UK. So any intangibles which are incurred outside India will be included in the value 500 UK pounds. So 500 UK pounds into 100. Okay. So that will be coming toward 50,000. Then next, license fee relating to imported goods payable by buyer as a condition of sale. So any royalties, technical fees, license fee should be included. How much is payable? 20% of price of the machine. So 10,000 into 20% into, so 100, that will be 2 lakhs. Okay. So 2,000, 20% of 10,000, 2,000 into 100. So 2 lakhs. Now 10 lakhs plus 50,000 plus 2 lakhs. So that will be equals to 12 lakh 50,000 is taken. Okay. We don't have any other. Materials and components supplied in UK by the buyer free of cost valued at 20,000. Should that also be added? Yes. That should also be added. Okay. That should also be added. And then next, insurance, buying commission. Buying commission will not come. Buying commission will not come. So any other details? So nothing for revised FOB. Freight and insurance will not come. Now it will come after revised FOB. To the revised FOB, what are the additions? Importer paid 500 towards demurrage charges. That is post import. It will never come into the value. Okay. So now we need to take that 12 lakh 50 plus 20,000, 12 lakh 70. This 12 lakh 70 is taken as the revised FOB. Revised FOB. To this revised FOB, we need to add freight and insurance. What is the freight? Air freight. Actual or 20% of FOB. What is actual? 3,000. So 3,000 into 100, that is 3 lakhs. Okay. Actual 3 lakhs. Actuals 3 lakhs. Actuals is 3 lakhs. Actuals is 3 lakhs. And 20% of FOB. What is 20% of FOB? FOB is 12 lakh 70,000 into 20%. That will be 2 lakh 54,000. Whichever is lower should be taken. That's why we are taking 2 lakh 54,000. Okay. Whichever is lower should be taken. So 2 lakh 54. Then insurance paid. So insurance paid should be taken 6,000 directly. When actuals are ascertainable, take actual 6,000. So we get the CF value 15 lakh 30, and that is the assessable value. Demurrage charges will not come, but ship demurrage charges will come. Ship demurrage charges are payable by the shipping company vessel for anchoring the vessel at outer space. So that ship demurrage charges will come in the value, but in the freight, okay, that too in freight. But in case of normal demurrage charges, which is payable by the importer for not clearing the goods within the stipulated time, will not come into the value. Okay, that is this. Then next question. So we got the value. So they are asking about value, computation of value only. Question number 7, briefly explain with reference to the provisions of Customs Act the relevant date for determination of rate of duty and tariff valuation for import through a vehicle where a bill of entry is filed prior to arrival of the vehicle. So in case of aircraft and vehicle, the relevant date for determination of rate of duty is date of presentation of bill of entry or arrival, whichever is later. So therefore in this case, the arrival date will be taken. Okay. The arrival date will be taken. Why arrival date will be taken? Because they filed the bill of entry before the date of arrival. So arrival date will be taken as per section 15. With reference to the provisions of customs valuation rules, explain briefly the chief reasons on basis of which the proper officer can raise doubts on the truth or accuracy of the declared value. That is, when there are identical goods or similar goods at a higher value and the importer has declared a lower value, or the sales involves an abnormal discount or abnormal reduction, or the sales involves some special discounts limited to exclusive agents, or there is some misdeclaration of goods, then non-declaration of parameters such as brand, grade, etc., or fraudulent or manipulated documents. So these are the doubts on the truth or accuracy of the declared value, and in that case the proper officer may reject that. Okay. Then next, question number 9. Jagat Corporation Limited imported some goods from US. The details of the transaction are as follows. Authority CBIC $1 equals to 70 rupees, RBI rate $1 equals to 71. CAF value of the goods is $1,50,000. Rate of basic customs duty is 10%. Rate of social welfare surcharge is 10%. Integrated tax is 18%. Ignore compensation cess. Calculate the total customs duty and integrated tax payable thereon. So here what will be taken as the total customs duty? First, CAF value of the goods is 1,50,000. Is it imported by airways? we don't have any information. So therefore directly we will take. What is the relevant date for determination of basic customs duty? 10%. So directly we need to compute the customs duty. RBI rate will be taken. So 1,50,000 into 71 will be taken as the assessable value. That is 10 lakh, 106 lakhs. 1 second. CIF value, CBIC rate, sorry, CBIC rate should be taken, not RBI rate, 70. So 1,50,000 into 70, that will be 105. Okay, 105 lakhs will be taken. And basic customs duty rate is given as 10%. Social welfare surcharge 10%. So 10,50,000 is basic customs duty, social welfare surcharge 1,05,000, and if you add that, and on that 18% will be IGST. So that is the total customs duty payable. It's a direct question. Then question number 10, ABC Industries Limited imports an equipment by air. Okay, air. CIF price of the equipment is $600, freight paid is $1,200, and insurance cost is $1,800 US. The bank realizes the payment from importer at the exchange rate of 61. We will not take that. CBIC rate is 70. That only we will take. So 70 rupees per dollar will be taking. ABC Industries Limited expends 56,000 in India for certain development activities with respect to imported equipment. That's a post-import expenses, will not come. So we need to first take what is the FOB price. Why? Because air freight is given, so we need to do the comparison. What is the FOB price? CIF price is 6,000. So you take 6,000, deduct freight, deduct insurance, you will get FOB price. To that FOB price, so any adjustment to be made? Nothing. This 56,000 will not come. So FOB price is whatever is given, $3,000. Now how much will be taken as freight? Actual. What is actual? 1,200 or 20% of FOB. That is 3,000 into 20%, 600. So 600 only should be taken as freight, and insurance will be 1,800. So 5,400 will be taken as the CIF price here. On that 5,400, we need to take, CBIC rate 70 rupees. So therefore 3,78,000 will be taken. And on that, basic customs duty is given as 10%. IGST 12%. So basic customs duty 37,800, social welfare surcharge 3,780, IGST will be 3,78,000, 37,800 plus 3,780 into 12%, 50,349. That will be the total customs duty payable. Okay. Usually this type of questions when they are giving, so they will be giving for some 5 marks like that. So involving both valuation as well as computation of customs duty, but don't forget to write the notes. Notes are very important. We should write that. Then compute the total customs duty and integrated tax payable under customs law on an imported machine based on the following information. Cost of the machine at the factory of the exporter is $20,000. This is a very important question, because in so far they have given only the price, but they did not give X factory cost. So this is X factory cost based question. So whenever we get a question based on X factory cost, what is the adjustment we need to make? So please keep in mind. So see this question. Cost of machinery at the factory of the exporter, X factory price $20,000. From there to the exporter's port, they are incurring some transportation charges, $800. And then for loading the machine into the ship, $50. Freight from exporting country to India, $5,000. Buying commission paid by importer will not come. Light rate charges paid by importer at the port of importation will come. Light rate and bar charges for bringing the goods from the ship to the shore. Freight incurred from port of entry to inland container depot, that is after importation, it will not come. Ship demurrage charges will be included into the value. Okay. Date of bill of entry, entry inwards. What will be taken as the exchange rate? Bill of entry date. What is the bill of entry date? 20th January. Exchange rate is 70 rupees per dollar. Okay. First what we need to do? Here we will take normally cost at the factory, $20,000. Then transportation from factory to port, $800. Then loading, $50. So this 20,850 is the FOB. Now convert it into Indian rupees, you will get into 70, 14,59,500. Add freight and insurance. So what is that freight? Normal freight for bringing the goods from outside India to India. How much it will be? So light rate charges, freight, so $5,000, okay, 5,000 into 70, 3,50,000. Light rate charges, okay, light rate charges will be coming, so you take that. Ship demurrage charges, sir, freight from port of entry to inland container depot is after it has entered, so post importation that will not come, but ship demurrage is payable before, so therefore the 24,000 will be coming, okay. And insurance is ascertainable in the question? No. So we need to take 1.125% of this FOB. So 14,59,500 into 1.125% will be what? So 16,419.375. So that will be taken. Now you will get CIF price. Okay, value we got. Then we need to compute the customs duty rate. So date of presentation of bill of entry or date of entry in words, whichever is later should be taken. So whichever is later is what? 25th March. On 25th March, what is the rate? 10%. So therefore, we need to take 10% as the basic customs duty. Social welfare surcharge is 10% of basic customs duty. Now integrated tax, we know how to compute. Okay. Now the same question, if they give 20%, that is freight not ascertainable. Freight not ascertainable. What we need to do when freight is not ascertainable? We need to take 20% of FOB as freight. So you do the computation regularly, 20% up to 20, like FOB, up to FOB you do normally. That is 14,59,000. Up to FOB it will not change. Up to FOB it will not change. Freight. Freight, when you take 20%, the 20% is all inclusive. The 20% is all inclusive means when you take 20%, 14,59,500 into 20%, so 2,91,900. The 2,91,900 already includes this $850. So what is this $850 into 70 rupees? That is this 59,500 is already included. So how much should be taken? 20% of FOB means 14,59,580. Sorry, 14,59,500 into 20%. When you take 2,91,900 minus 59,500 you deduct. So you take freight as 2,32,400. When you take 20% of FOB, that 20% of FOB covers freight from the exporter's factory. That's what ICAI has took as a view. So due to that reason, 2,91,900 minus already 59,500 is in FOB. So take out. So remaining only you add. What about light rate? Already covered. So when you take 20%, light rate is covered. Okay, light rate is already covered in that. Ship demurrage also already covered. Don't add anything extra. Then what will be taken as insurance? Insurance is same only. 16,419.38. Now what will be taken as the assessable value? The assessable value will be 14,59,500 plus 2,32,400 plus 16,419.38. So that will be 17,08,319.38 will be taken. Okay. Remember, this is the place where there is a change. So the moment you take 20% of FOB, the 20% of FOB includes freight from exporter's factory to the importer's place, including ship demurrage charges, light rate charges, everything. So therefore, don't add that again. So 2,91,900 includes 59,500 also. Take out that 59,500, remaining you add, and light rate charges, ship demurrage charges don't take. So that's how you need to modify the question. Then next, look into question number 12. So this is question number 11. Question number 12. Kaveri Enterprises imported some goods from Italy. On the basis of certain information obtained through a computer printout from the Customs House Department. So Customs House Department alleged that during the period in question, large number of consignment of such goods were imported at a much higher price than the price declared by Kaveri Enterprises. Therefore, department valued such goods on the basis of transaction value of identical goods. So, on the basis of comparable imports, what department is doing? They have rejected the value and they determined the value as per rule 4, that is identical goods, and demanded the differential duty along with penalty and interest. However, department did not provide the printouts on the basis of which they are going for that identical goods. That information was not provided. Kaveri Enterprises contended that department's demand was without any basis in law, without any legally admissible evidence, and opposed to the principles of natural justice, as the computer printouts which formed the basis of such demand had not been supplied to them. Resultantly, they had no means of knowing as to whether any import of comparable nature were made. You are required to examine the contention of Kaveri Enterprises based on decided case law, if any. There is one case law, that is Gira Enterprises case, Supreme Court case. Gira Enterprises Supreme Court case is there, which says that if the department on the basis of comparable imports is rejecting the declared value by the importer, they should make available those printouts on the basis of which they are going for the rejection and taking identical goods. Otherwise, it will be not in accordance with the principles of natural justice. So, since revenue did not supply the copy of the computer printout which formed the basis of conclusion, so appellant obviously could not and did not have opportunity to demonstrate that the transactions relied upon by revenue were not comparable transactions. So, in view of this judgment, the contention of the Kaveri Enterprises is correct, that so they cannot, like just like they reject the value, there should be make available as to the reason why they are rejecting the value declared by the importer. Okay, that is this Gira Enterprises case. Then question number 13, Messrs. Impex imported some consignment of goods on 1st June. A bill of entry for warehousing of goods was presented on 5th June and the materials were duly warehoused. The goods were subject to duty at 50% ad valorem. In the meanwhile, on 1st July, an exemption notification was issued reducing the effective customs duty at 30% ad valorem. Messrs. Impex filed their bill of entry for home consumption on 1st August, claiming duty at 30% ad valorem, but customs department charged duty at 50% ad valorem, being the rate of duty at the time of clearance, with reference to the provisions of Customs Act, with section 15. So, the rate of duty applicable for clearance of home consumption in case of goods deposited in warehouse, as per section 15, the relevant date for determination of rate of duty and tariff valuation is the date on which ex-bond bill of entry for home consumption is presented. Okay. Therefore, the rate of duty prevailing on 1st August, that is 30%, should be considered. Whether the rate of exchange on 1st August could be adopted? No. For the purpose of exchange rate, we need to take the date of presentation of inbound bill of entry. That is, on 5th June, they presented one inbound bill of entry, that should be taken. Okay. So, on 5th June, they presented one inbound bill of entry, that should be taken for the purpose of exchange rate. Okay. See this. Question number 13, 1st August, rate of duty, and 5th June should be taken and not the exchange rate prevailing on 1st August. Then next one, question number 14, differentiate between deductive value and computed value. Deductive value, what we will do? We will take the price at which the imported goods are sold at the first level in greatest aggregate quantity minus post-importation expenses and minus even processing cost, and then customs duty or any duties payable after importation will be excluded. So, we get the deductive value. Whereas computed value, we take the production cost, general expenses plus usual profit margin and freight and insurance, and we will arrive. So, both follows different approaches. Deductive value follows bottom up approach, whereas computed value follows top down approach. Okay. Then what is residual method of valuation? So, in case when the value cannot be determined as per identical goods or similar goods, or computed value, deductive value, then officer shall determine the value, that is residual value. Then enumerate various costs and services that are to be added under Rule 10 of the customs value to arrive at the transaction value. As per Rule 10, Sub Rule 1, 4 costs should be added. Number 1, any expenditure incurred by recipient on behalf of supplier, selling commission, container cost, packing cost. Number 2, any material sent by the importer to the exporter free of cost, or any consumables, or any molds, tools, or any artwork, design work, drawings, etc., which are incurred outside India. So then such cost on actual basis or amortized cost or apportioned cost should be included in the value of the imported goods. And any other expenses charged by the exporter to the importer before import should be included, even after import as a condition of sale of goods should be included. This is as per 10.1. As per 10.2, Rule 10.2, we need to include freight and insurance. So freight actuals, ascertainable, we will take actuals. If it is other than air freight, if it is air freight, actual or 20% of FOB, whichever is lower. Whereas in case insurance, ascertainable actuals, not ascertainable, we will take 1.125% of FOB. Okay, that is in this case. Then in the context of customs valuation, so determination of price of imported goods, explain the meaning of similar goods, identical goods. Identical goods means imported goods having the same physical features and characteristics from the same country and manufactured by the same person, preferably at or about the time of importation. Whereas similar goods, imported goods, commercially interchangeable from the same country, manufactured by the same producer, preferably at or about the same time. Okay, that is the difference. Briefly discuss the provisions relating to date for determination of rate of duty and tariff valuation on imported goods. About section 15 we need to write. As per section 15, in case imported goods are cleared for home consumption and the import is by vessel, the relevant date for determination of rate of duty is date of presentation of bill of entry or grant of entry inwards, whichever is later. In case of aircraft or vehicle, date of presentation of bill of entry or arrival, whichever is later. In case of imported goods taken to warehouse, the relevant date for determination of rate of duty is the ex-bond bill of entry for home consumption to clear the goods from the warehouse. So that section 15 provisions we need to write. Then question number 19. Product Z was imported by Mr. X by air. The details of import transaction are as follows. Price of Z at exporter's factory 8,500. Again, this is X factory price 8,500. Freight from exporter's factory to the load airport. Loading and handling charges at the load airport. Freight from load airport to the airport of importation in India, insurance charges. Okay, though aircraft arrived on 22nd August, the bill of entry for home consumption was presented by Mr. X on 20th August. So we need to take date of presentation of bill of entry or arrival of aircraft, whichever is later, for rate of duty. So 22nd August, whatever is rate, that will be taken 10%. Whereas for exchange rate, we need to take bill of entry date. What is the bill of entry date? 20th August. That to exchange rate notified by CBIC should be taken. So 70%. Basic customs duty 22nd August. IGST also 22nd August. Exchange rate alone 20th August. That is 70 rupees per dollar. Compute the value of product Z and customs duty leviable. First, we need to take normally price prevailing at the exporter's factory. So how much? $8,500. See this. $8,500. So this we will take. Add. So cost of transportation from there to here, there to exporter's port, factory to exporter's port, and loading and handling charges 250. How much? 500. So what will be the FOB price? 9,000 will be taken as FOB. Now for that freight we need to add. So what is the actuals? Actual freight will be, so 4,500. Actual freight will be 4,500. And B, 20% of FOB. What is 20% of FOB? So 9,000 into 20%. That is also coming that is coming to 1800. So now what you need to do, you need to add to this 9000. So what is the FOB you got? 9000. So 9000 into 20%, 1800, whichever is lower. So whichever is lower is 1800. So when you take freight, air freight, what you need to do? Don't take 1800. In that 1800 already this 500 is there. So minus 500, how much you need to include? 1300. And insurance ascertainable. Insurance ascertainable here. Insurance, yes, 2000. So you take directly 2000 insurance. Now what you get will be 9000 plus 9000 plus 1300 plus 2000, that will be 12,300. Convert into Indian rupees at 70. So 8,61,000 will be taken. Understood or not? What you need to do? So I am just giving you a simple way. First you calculate normally FOB. Then you take the air freight. Air freight actual or 20% of FOB, whichever is lower. So when you take whichever is lower, the moment you take whichever is lower, in that already whatever you have included for FOB, that freight from factory to load airport and handling charges at the load airport, you take out. So remaining you add, you will get the correct answer, 8,61,000. For that 8,61,000, you need to add, so customs duty and all, that is normal. Customs duty 10% and then IGST 12%. So that you know how to compute. Basic customs duty 10% of 8,61,000, 81,600. Social welfare surcharge 8,610 and IGST, these 3 into 12%. So total customs duty payable. Okay. So this is the easiest way to arrive at the value whenever we get the ex factory price. Now there is another question with ex factory price. Okay. Question number 20. An importer from Cochin import goods from an exporter in US. The vessel carrying the goods reaches Mumbai port first, and from there goods are transshipped to Cochin port. Determine the assessable value of imported goods under Customs Act 1962 from the following particulars. Cost of machine at the factory of the exporter. So ex factory cost $20,000. Transportation charges from factory of exporter to the port of shipment, and handling charges paid for loading the machine in the ship. Okay. Buying commission will not come. Freight charges given. Now no problem. The moment when you take 20% of FOB only, the problem will be. When you are not taking 20% of FOB, there is no problem. Directly you will take freight charges from exporting country to India, actuals only you will take. When that is not there, only the problem will come. Okay. And actual insurance charges not ascertainable. Charges for design and engineering work undertaken in US, definitely it will be included. Unloading and handling charges paid at the place of importation, it will never be included. Sir, this is post importation. Unloading and handling charges paid at the port of importation is after import only we do unloading, that will not come. Transport charges from Mumbai to Cochin port, again it is post import. Transshipment or transita? Transshipment. See there, an importer from Cochin imports goods from an exporter in US. The vessel carrying the goods reaches Mumbai port first, and from there goods are transshipped to Cochin port. This is a transshipment freight. Transshipment freight will not be included in value. Which will be included in value? Transit freight only will be included in value. So transshipment freight will not come. Exchange rate $1 equals to 70. Simple pa. What we will do? First we will take price at the factory, $20,000. Then what and all will be included in FOB? So transportation cost from factory to the port 1,000. Then loading charges in the port 100. Then anything, design and engineering work 5,000. Okay, buying commission will not come. Any other charges? No. So therefore it will be FOB value 26,100. Now freight, actuals, ascertainable, take actuals 2,000. Suppose if it is not ascertainable, sir, then when you take 20% of FOB, so 26,100 into 20%, so 5,220. From that 5,220, you deduct 1,100. Why you need to deduct 1,100? because it is already included there in FOB. So remaining you will take like that. Okay, but here actuals given, you take actuals, and insurance not ascertainable, so we will take 1.125% of FOB. So 26,100 into 1.125%, that will be 293.635. Then, so transportation charges from Mumbai to Cochin port will not come because it is transshipment. If you add this, that will be CIF value that you convert into Indian rupees. Even unloading charges will not come, that you convert into Indian rupees at 70 rupees per dollar. You get the assessable value 19,87,554. Okay, so it is easy. This way only we need to do. Next, question number 21. ABC Industries Limited of Mumbai imported one machine through vessel from where? From Japan in the month of November. The following particulars are made available. Cost up to the port of exportation incurred by the exporter. What is it? FOB price given. FOB price given 6 lakhs. Loading charges at the port of exportation 25. So that will you add 6,25,000 is only FOB. Okay. 6,25,000 is FOB. Freight charges from port of export to port of import, thereafter it will come. Design and charges necessary for such machine paid to consulting firm in New Delhi. No, it will not come. Sir, any designing charges, artwork, intangibles, when we are incurring in India, it will not come. Only when it is incurred elsewhere than in India, then it will be included, because when it is incurred in India, already we are paying GST on that. No need to include it in the customs. When we are incurring it outside India, on the GST will not be paid. That's why they are telling when you are paying it as an importer on behalf of exporter, you include it in the value. On that customs duty is payable. That's the logic. So this 8 lakhs will not come. Commission paid, not the buying commission, to the local agent of exporter. Yes, local agent commission means exporter's agent part. Because who is there in India is exporter's agent, that is local agent's commission means selling commission, it should be included in the value. Actual landing charges paid at the port of importation will not come because it is after import. The unloading charges, everything will happen after import, that will not be included. Don't include that. Actual insurance charges paid to the place of importation not ascertainable. So we will take 1.125% of FOB. Light rate charges paid at the port of importation. Yes, it will come. Why? Because it is for bringing the goods to the port. So it will be included in the freight. Okay. Now, what we need to do? First we will take, so exchange rate. Rate of basic customs duty 10, social fare surcharge 10, integrated tax 12. Ignore GST compensation test. Rate of exchange 1 yen equals to 0.71. Now, first we will ascertain the FOB price. So, what is that FOB price? So, this 6,25,000 multiplied with 0.71. So, then you will be getting 4,43,750 as the FOB price given. But to that FOB price given, we need to make adjustments. So, what is that? Selling commission we need to add. So we will add selling commission, but that selling commission is given in Indian rupees. 8 lakhs will not come, only 1,25,000 will come. That 1,25,000 will be added, 15,000 will not come. Light rate charges will be part of freight, so that we have not yet done. So therefore 5,68,750 is the FOB as per customs, means revised FOB. For that revised FOB, freight should be taken. Actuals ascertainable. So take actuals. How much freight for bringing the goods from there to here? 1 lakh. 1 lakh into 0.71, 71,000, and add light rate charges 21,000. So 91,000 it will be. Okay. 1 lakh into 0.71, 71,000 plus 20,000 light rate added. Insurance not ascertainable. What is the revised FOB? We got 5,68,750 into 1.125%. That will be, so 6,398.43 insurance. You got the CIF and the assessable value 6,66,148. Rate of customs duty given in the question itself. So we will take whatever is the customs duty that is given in the question, 10%. So 10% of this, that is 66,615 and social welfare surcharge at 10% of this, 6,662. So total on that IGST will be computed. So total customs duty payable 1,62,008 rupees. So these are the type of questions that you get on valuation under customs. And one more question, last question. This is on rule 8, customs computed value. Okay, say this. Mr. X imported certain goods from a related person, Mr. Q. So who are treated as related? So there is a definition for related which is same as per GST and customs. Okay. So what is that? Such persons are officers or directors of one another person. Such persons are officers or directors in one another's business. Okay, that is common in GST as well as customs. Second, they are legally recognized partners of a firm. Same in GST and customs. Employer and employee, same. These are the 3 points. First 3 points. Next 3. Any person directly or indirectly owns, holds or controls 25% or more of the outstanding voting stock or shares of both of them. So two companies having a common shareholder with 25% makes those two companies related. 25% is required in GST, but in customs just 5%. 5% makes them related. Okay. Then next point. So fifth point, one person directly or indirectly controls other. Here also directly indirectly controls other. Control is not defined in both the places. So usually control will be investment more than 50% or controlling the majority common board of directors. So then point number 6, they both are under the common control of a third person. Same. Then next point, together they control a third person. Same. Then they are members of the same family. Family is defined in GST, that is spouse and children, whether or not dependent, brothers, sisters, parents, grandparents, if they are wholly and mainly dependent. But like that we don't have definition of family in customs. And sole selling agent. So sole selling agent, common point we have. So the same meaning of related in GST is copy pasted in customs. Actually GST only came later, customs first. So customs, and that is came in GST. What is the difference? So in the fourth point, so with 5% investment in two companies with a common shareholder makes those two companies related, and family not defined. These are the two differences. Now, so in case of related party transaction, we will not take the transaction value. The value will be determined in terms of rules. So rule 4 not applicable. Rule 5 not applicable. So therefore the value is determined as per rule 8. So rule 7 should come now, but rule 6 says we can choose between rule 7 and rule 8. So therefore rule 8 has been chosen. Now as per rule 8 we need cost of production plus usual profit margin, general expenses plus freight and insurance to India. That should be taken. Cost of materials, will it come? Yes sir, that will come. 2000 will come. Fabrication charges, where? There. It will come in cost of production. Yes, that will be part of cost of production. Other chargeable expenses incurred by Mr. Q, $400, that will also come. Okay, so 3,400. Then other indirect cost incurred by Mr. Q, 250. Yes, that will also come. Freight from Q's factory to US port, is it also part of cost? Yes, that is also part of cost, 250. Then loading charges at the US port, 100, that will also come. So total $4,000 is the FOB. No, not FOB. $4,000 is what? Cost of production. But what is FOB? To this cost, if you add profit, you will get FOB. What is the profit margin? Profit margin is 20% of FOB. So when profit is 20% of sale price, then what is it on cost? So 25% on cost, 20 by 80, correct? So they have given 20% of FOB, sale price 20% is profit, then on cost it will be 25, that is 20 by 80. So therefore 25% on cost. For 4,000, 25% is what? 1,000. So FOB price is $5,000. FOB price is $5,000. FOB is $5,000. Okay. Now, what they are telling, air freight from US port to Indian port, that should be sea freight, na? But they are telling air freight means it is an airport, let it be. What is our botheration? In case of air freight, what we will do? Actuals. What is actuals? 1500 or 20% of FOB, that is 1000. Whichever is lower, 1000. But already we need to make one adjustment. Already we have incurred factory to port and loading charges at port, which is already there in 20% of FOB, which we included in FOB, which is already there in 20% of freight. Yeah, 20% of FOB when you take, so this will be included. That is this 250 and 100. This 350 is already there. So in FOB again don't add. So that's why $350 we will reduce. We'll take $650 as freight. Then insurance. How much will be taken as insurance? Insurance will be US port to Indian port, $50 that will be taken. Okay. Then how much will be that? So $5,700. $5,700 into 70 rupees. 70 rupees is what? 5,700 into 70 rupees, that will be 3,99,000 will be taken as the value. Say this 3,99,000. So this adjustment is what many students will be missing. So be careful when they give the factory cost. So the freight from factory to the port or airport, loading charges at the port or airport, when you take, you get FOB. But when you take 20% of that FOB, so you ensure that you take the 20% of FOB and you deduct that two cost. What is that? Factory to port or airport and loading charges at port or airport. Then you will get the correct answer, 3,99,000. And what they are telling, the customs authorities are of the opinion that since value as per rule 7 can be determined at 4 lakhs, that is deductive value, there is no need to apply rule 8. Can the request of Mr. X be legally acceptable? Yes, because rule 6 says when there is deductive value, that is similar goods, identical goods not applicable, we can go for deductive value or computed value at the option of the importer. So in this case, he can go for computed value, which is 3,99,000. So what is the assessable value in this case? Assessable value will be 3,99,000. That should be taken. Okay. So this is the spectrum of questions now that you can expect on valuation under customs. Okay.